When people think about investing costs, they usually think about obvious fees, a commission, a transaction fee, something clearly labeled. But many of the costs that affect beginners aren't loud, they're quiet. And because they're quiet, they're often ignored. Let's start with one of the most common ones, expense ratios. If you buy an ETF or a mutual fund, you are paying a small annual fee for that fund to operate. It might look small, 0.2%, 0.5%, maybe 1%. That doesn't sound like much, but here's where it matters. Let's say you invest $10,000 into a fund with a 1% annual fee. That's $100 per year. If your account grows to $100,000, that same 1% is now $1,000 per year. You don't see a bill. It's taken out automatically from the fund itself. That's why it feels invisible. Another quiet cost is trading too often. Even if commissions are low or zero, frequent buying and selling can create hidden costs. You may buy at slightly higher prices. You may sell at slightly lower prices. Over time, small inefficiencies compound. There's also something called the spread, which we discussed before. Every time you buy or sell, there is a small gap between the buy price and the sell price. That difference is a cost of trading. If you trade often, you experience that cost often. Another quiet cost comes from holding cash. If money sits uninvested inside your brokerage account, it may earn very little. Meanwhile, inflation reduces purchasing power over time. Even without visible fees, money can lose value by simply doing nothing. Now let's talk about a cost many beginners don't expect: emotional decisions. Buying because something is trending, selling because prices drop, reacting to headlines. Those decisions can create losses that feel like market problems, but are really behavior problems. The market does not charge you for being impatient, but impatience can be expensive. Here's a simple comparison. Investor A chooses a low-cost ETF and holds it consistently. Investor B chases trends, switches investments often, and pays higher fund fees. Over 10 or 20 years, the difference can be thousands of dollars. Not because of dramatic mistakes, but because of small, repeated costs. This is why understanding fees isn't about being cheap, it's about being aware. Every percentage point matters, every unnecessary trade matters. Every decision has a cost attached to it, even when it isn't labeled as a fee. The goal isn't to avoid all costs, the goal is to understand which ones are worth paying, and which ones quietly reduce your results. Once you start noticing these quiet costs, you stop focusing only on returns, and you start paying attention to what you're giving up along the way. That awareness alone can make a bigger difference than trying to pick the perfect investment.